Chapter 11, Cost of Capital. The Chapter 11, like Chapter 8 and 9, is a chapter where you're going to employ a lot of the concepts that you learned earlier in the semester. So we're gonna talk about the components of the cost of a company's cost of capital, debt, preferred stock, retained earnings, new common equity. We'll talk about the weighted average cost of capital, or WACC, discuss the logic of using the weighted average cost of capital to make decisions, corporate decision making. Describe how the marginal cost of capital, or MCC, is used to make capital budgeting decisions. Discuss the relationship between firms' weighted average cost of capital and investors' required rates of return. So, cost of capital, what is it? Represents the firm's average cost of funds, which is should be, if the markets are in equilibrium, should be the average return required by a firm's investors. What must be paid to attract funds, the return that must be earned on invested funds to cover the cost of using those funds. So this is important. If that's why we use, like, go back to Chapter 9, that's why we use the net present value. Typically, we would use a firm's weighted average cost of capital as that hurdle rate or required rate of return. But if a firm invests in a project that doesn't achieve that, it's actually going to reduce the value of the firm. That's an important concept. Firms with required return. The investors, are participants in the financial markets. They determine a firm's cost of funds. The firm's cost of funds change when the financial markets change, when investors' risk aversion changes. So you look in the markets right now, the markets have certainly rebounded, but there's investors' risk tolerance has certainly changed with as the pandemic has moved forward and so forth. That changes the value of their required returns and so forth. Changes in a firm's risk, changes in operations. If you think about a firm that had a product that was a very popular product, but it's declined over time. The opposite can happen too. A product can not necessarily be all that popular, or be newly introduced to the market and take off, and that can certainly improve the risk associated with a company. Basic definitions, capital components. So types of capital used by firms to raise money. R sub D, or subscript D, the before tax interest cost or cost of debt. RDT is the after tax cost of debt, and that is RD. It's equal to the before cost of debt multiplied by 1 minus the marginal tax rate. RPS is our subscript PS is the cost of preferred stock. RS is the cost of retained earnings, and RE is the cost of external equity. So when a company has to go out and issue new stock versus using retained earnings, is effectively self-funding. So weighted average, WACC, is weighted average cost of capital. Capital structure is the combination of the different types of debt and equity used by a firm. So, cost of debt. The after-tax cost of debt is what we're talking about. RD subscript DT. Relevant costs of new debt. So you have to account for the tax deductibility of interest. The before tax cost of debt is the yield to maturity on the firm's debt. So required by the return are required by investors. So the after-tax cost of debt, they are subscript DT. Is the bondholder's required rate of return minus the tax savings. So the RD minus RD R sub D times the marginal tax rate, or we can simplify it by R sub D multiplied by 1 minus the marginal tax rate. Example, firm currently has debt, following characteristics will wants to issue debt to support future growth. They're going to issue a $1,000 maturity value bond with a 9% coupon rate paid semi-annually. The years to maturity is 12 years, so that's going to be 24 semi-annual periods, and the current market price is $931. The marginal tax rate is 40%. So we can use, based on that information, we can solve this equation in a formula. It's kind of difficult, but this is what it looks like. We'd set that $931 price equal to the present value of all of the future coupons and the return of that maturity value or principal at maturity. So again, there's 24 periods. Solving for the RD kind of difficult. Can be done on a graphics calculator. Fairly easy to do in Excel. So financial calculator N is going to be 12 times 2, 24. Present value is the market price of the bond. The negative 931 payment is 1,000 times the coupon rate of 9% divided by 2, and future value is the principal or maturity value of the bond. And we enter those, compute IY. That's 5%. Should get. That's a semi-annual rate. So what we have to do is because it's a semi-annual calculation, we have to multiply by 2 to get the annual yield on that bond. So again, the firm's marginal tax rate is 40%. So the R subscript DT, or the after-tax cost of debt, is that 10% yield on the bonds multiplied by 1 minus the marginal tax rate of 40%. So that's 10 times 0.6 or 6%.